Hello everyone, just a quick sound check before we get going. If you can hear me okay, just type yes into the little question area and we'll be ready to go in 4.5 minutes. Very good, thank you. Okay, welcome everyone. Just give me one moment to get the recording going. Okay, we're recording. Okay, so welcome everyone. Again, apologies for that. It just goes to show the best laid plans. Now we're in week 5 this week. I want to bring together the concepts we've talked about over the last 4 weeks. This is a little bit more laid back this week, and go over some interesting things that have occurred during the week. There we go. So the information contained in this material is intended for general advice only, does not take into account your investment advice or objectives, financial situation or particular needs. So you must consult a licensed advisor before acting on information you may see or hear. This series was put together really around those that have come to the market and looking at trading FX or looking at trading futures contracts or even equities. And FP approached me to put a series together to really sort of get people started and bring in a little bit of understanding about risk management, that type of thing. So I'm going to cover that again tonight. Just a little bit of background about myself. I'm currently a member of APTA, the Australian Professional Analysts Association. I write for Reuters and First Prudential and Trading Edge magazine, and I currently trade my own account. As always, if you haven't done it by now, you must do it now, is clean up your desk so that only your business is on the desk. Anything you need to trade with, your screens, your laptop or your computer, that type of thing. Just keep it nice and tidy so there's no distractions around you. And again, one of the attendees in this series, he's been here every week, is a chap that has mentored me over many, many years. And he really brought home this message that successful trading is not about so much how much you make, it's really about consistency, but it's how much you don't lose. And that was a significant change in my view around trading as well. And I see the issue with traders these days, of course, as have been for a long time, is that risk is just far too high. Yeah, and talk about conviction trades and all the rest of it, and they end up not really working for themselves. So this quote here brings together what I do want to talk about. When you first start to study a field, it seems like you have to memorize a zillion things, and you don't. What you need is to identify the core principles. So generally 3 or 4 of them that govern the field. The million things you thought you had to memorize are simply various combinations of core principles. Now that's what I've tried to convey over the past 4 weeks. I'm going to try and wrap it up this week into these just core observations of the market that you can build a foundation from and start to get some organization into your trading. Linda Rajke, who I have a lot of time for, she makes a point that it's the time spent on preparation outside of the regular trading hours that makes a trader successful. And it's like any job that you have. If you consider your career, a lot of people go, well, trading must be easier than my career job that I've got at the moment, and they find out that it's not. They find out it's still an enormous amount of work and preparation when they get down and take it really quite seriously. So don't be afraid of the work around it. It becomes easier and easier over time, and the markets are always dynamic and will always keep your interest. We made mention that this concept about the better I become at technical analysis, the better trader I'll become, which is simply not true. The analysis is really about consistent analysis of past data, and we're building some rules around how we're going to use that data, and then looking for entry and exit conditions. But the trading side of things is, a lot of people think it's has a lot to do with psychology. No, it doesn't. The trading side of it is just the basic record keeping, your risk, your money management, your position sizing, brokerage if that's an issue, and the psychology of profit and loss. There's a few Bitcoiners dealing with the profit side of that at the moment, wondering where it's all going. So the purpose of the series has been to build a disciplined approach, starting with some stats. So we've done that in week 2. If you haven't seen the earlier webinars, they're on the FP YouTube site. We looked at indicators, then we looked at simple trading plan, which I'm going to go over again today, and then some price action with a plan today. So when you bring it together, when you sit down in front of your screens and your desk and you go, okay, what am I going to do? One of the key things about this that I've found over the years is you really have to stop the noise. The noise around you, which is your chat sites and your Twitter and those types of things. They're fun when things are quiet, nothing much happening. But when you want to think about what you're actually doing, because you are responsible for what you do in front of your screen, and you are responsible for the outcome, win, lose, or draw. So you need to become your own source of inspiration, your own source of knowledge gathering, if you like. If something interests you, if you want to find out, if you want to put an RSI, a relative strength indicator, onto your chart, go and find out how it actually works and understand how the basic thing works, and it will give you a lot more insight, and then you'll own the knowledge, that type of thing. And I've encouraged people over the past 4 weeks to understand simple little price patterns and go and find them themselves and see if they actually work. And so then our trading comes simply down to price action based repetitive patterns. Now, none of the talk over the past 4 weeks we've never really entered into this, and I see it day after day, is people say, well, it's going to go. I think it's going to go. I'm sure this is going to be big. That's not actually trading. That's kind of like sort of betting on an announcement or betting on something or other, but it's not actually trading data that comes across your screen. And we're interested in trading the data that comes across our screen and being focused on that. So then we take a fixed risk approach, a fixed dollar risk approach, and then we simply repeat to generate an outcome. So we simply want to find something that works for us, and I'll go through a couple of those things today, but find something that works for us, disregard all the noise around you, say thank you, but no thank you, and simply repeat what you're doing on there. So the questions I would ask that if you can have any questions, can you post them as early as you can? We get to them quite late in the past week. So if you could post your questions now or anything like that, then I can sort of get to them as we're going along. Very good. Very good. So if you could post questions now, it'd be fantastic. Okay, so as I mentioned earlier, on the FP Markets YouTube site, you'll find this series of webinars, and the 5th one will go up tomorrow, I guess. But if you go to YouTube, just search FP Markets, subscribe to the website, and you'll get a note every time one comes through. On the website, you'll find an enormous amount of information, including the week ahead. Evan Lucas presents that. I've worked with Evan in the past at IG Markets. Very, very knowledgeable guy around the fundamentals of the market, and worth looking for. So the other resource that you have available to you is on the FP Markets website. And if you look under resources, the technical analysis section there, this is where the black and white report goes in that I write once a week. If you don't want to read what I say, which is fine, just take a look at the charts and see how the charts are marked up, because they're all marked up, as far as I know, correctly, textbook correctly, and they're a good learning tool in themselves. Also, outside of you'll find this fundamental analysis area there. This is where Evan puts his work in there, and there's an overnight wrap and a daily outlook, which will get you going. And it doesn't hurt to read the Fin Review every now and again. I wouldn't take any trading advice out of there, but it just gives you a bit of insight into how things play out on a week after week basis. If you can pick it up on the weekend or something like that, have a scroll through it, and it's sometimes quite an interesting read, and it gives you themes often to look at and see what's playing out in the markets itself. So the only concept that we need to focus on is just develop a simple strategy and just simply backtest it. And I've advocated backtesting it by hand. You can build put it into MT4 and backtest it, or any other program if you like, and backtest it. I would advocate at least getting the concept together by hand, not just randomly putting in conditions inside some backtester and pressing the button to see how it works out. That really is not that helpful when it comes to understanding the markets themselves. So then we ask, well, what time frame am I using? So when we sit down to develop up a trading plan or develop up our approach, we really want to understand what time frame we're using in our observation of the markets. And then is there a daily window or a time of day that works best, particularly if you're intraday trading? Is there a time that that really works better than any other time? So this chart here, you can see some parallel lines on there, and they simply mark off in Australian time. They simply mark off. This is the S&P 500. The 3 o'clock to 11 p.m. So essentially the European Open of the continuous contract, the ES contract. And we can see it's actually, I'll get my pointer out, here we go. So this line here across to here, this is essentially 3 o'clock to 11 o'clock. And so it divides, it allows us to see the breakup of the trading cycle over a 24-hour period. So this is essentially the European Open of the S&P 500 contract coming into the US actual cash contract open, and see what happens after that. But often because we're in this time frame, in this case I was looking at, or am looking at, the effectiveness in this European window, this 3 p.m. to 11 p.m. Window. All right, so it comes down to understanding position sizing against our account size. This is the single most destructive thing that a trader can do to their account, is not understanding their position size against their account size. By taking an ego-based trade that everyone's talking about on Twitter or everyone's talking about on Hot Copper, yes, this must be good, I'm onto it. The fact of the matter is that not many of those work out. I track a lot of them and not many of them work out, or the volatility is so high, you'll end up with a sleepless night or nights before anything comes out of it. So it comes down, you must develop this that suits you, that allows you to sleep at night, that doesn't give you stomach cramps. If you open a position, it's not such a big deal to your well-being. So understanding this position sizing against your account size is, as far as I'm concerned, in my 20 years of experience and the mentoring that I've had, is the single difference between success and failure in this game. You can understand all you like about technical analysis and understand all you like about fundamentals, but if your position sizing is wrong against your account size, you're up against it right there and there. So we come down to this, I talked about this position sizing concept, and what we can control and what we can't control. If we have an entry level, whatever our entry level is, they're the only two things that we do know is our entry level and where our stop loss is. And this is essentially the stop loss side of your account, or this risk, if you like, is limited to your stop loss. From your entry to your stop loss point is a limit on your loss. It is the only thing that we could control where it goes. If the trade is working for us, then the upside is deemed to be unlimited, and we can then look at taking exits based around different concepts. But the only two things that we can ever control are the entry level and the stop loss. And the reason that we do back testing is to ascertain the principles around how many times we might actually be in a losing trade, a win-loss ratio, that type of thing. So there are no surprises. When the trade goes to a loss, it's not a surprise, it's just part of the routine of the trading plan that you have. And it looks like this on a chart, if you like. If your entry level here, for whatever reason, in this case, I've got a pivot point here, But your entry level, if we choose to put our stop level at the bottom of the bar that made the low, we can then work at this as a fixed amount. If the market moves to this stop loss level, we simply hand over a fixed dollar amount, which has already been decided before we enter the trade. So this becomes our risk. It does not matter where we put our stop. A lot of people kind of glaze over when I say that. It actually does not matter where you put your stop. You can put your stop anywhere you like. But what matters is that wherever your stop loss level is, the distance from your entry to your stop still assumes the same amount of risk in dollar values out of your account. So if you're willing to risk 1% or 2% or 5% of your account, it should reflect from the entry level to your stop level, and no matter what trade that you're working with. So that looks like this, a fixed percentage of the account, and I've used 1%. There are lots of ways of looking at this. I understand that. To get started on this, I'm going to use just 1% of the account. We're going to risk it can be 2% or 5% or anything like that, but we just use a hard number just to get the concept down. So if we had an account size of $10,000 and we're willing to risk 1% or $100, then we obtain our stop loss in dollars and cents or pips or points, and we divide that amount into our $100 to give us a position size, is the way of doing it. Now, we went through this last week. And so if we were looking at an FX contract and we're willing to risk $100, we'd be looking at 25 pips. So 25.0025 divided into 100 gives you a position size of 40,000 or 0.4 of a contract. In the same in equities, if we're willing to risk $100 in a trade, and we're looking at a distance of 35 cents to our stop loss, we simply divide that 35 cents into the $100 and gives us a position size of 285 units. So if it goes to our stop loss, we lose our $100 and then we move on to the next trade. In the futures market, for example, in gold, if we're willing to risk $100, now I just point out, and you also needs to be taken into account in FX, but in gold, if we're willing to risk $100, it's based in US dollars. So it looks like a 100-ounce position, but actually if you work it out in Australian dollars, back in your Australian dollars, it's simply a 75-ounce position, because the Aussie dollar is 75 to the dollar, around about at the moment. And that needs to be worked backwards just to give you a $100 Australian loss. Otherwise, if you take a $100 US loss, there'll be $132 missing out of your account should the trade go to your stop. The points are calculated, or pips are calculated from the last digit on the right. So this 1.16 is calculated as 116 points. And so the concept we first looked at around our developing up our trading plan was this primary and secondary markets. And we said that the primary trends are only observed on a weekly chart. I'm going to go a little bit further with that today and look at some other timeframes. But when we sit down and work out where something is going, we really want to stand back and look at it on a weekly chart. It requires an observable trending action. And then trends are developed on trending action, consolidations, or the secondary movement, which is an incredibly important part of our trend development, is this secondary movement, and corrective actions. So trend, we said that a trend would be defined as an uptrend when the market formed a higher low, and when it moved past the previous high at this point here, it is defined as an uptrend. And we're looking for this retracement here to be around about 10% of price. And we mentioned that this retracement can be up to 30% of this advancement leg, 30 to 60% of this advancement leg, and still be regarded as an uptrend as it unfolds, until we see the lower high come in. And then as the market breaks a previous low, it is defined as a downtrend. Downtrends are not defined by moving averages one over another, because you can have an infinite number of moving averages, and traders often change them around to make them show what they want to see. If their back is to the wall, they'll pull indicators and moving averages and what have you. Price action is the only thing that's going to put money into your account, so it's price action we need to use to develop up our trading strategy. So on a market, this underlying trend, a series of higher highs and higher lows here. So this is a weekly chart. This is where we define our trend by a series of higher highs and higher lows. And we have these areas of secondary consolidation come in. And often these areas of secondary consolidation, when looked in a lower time frame, look like a different type of trend. So in the daily chart, this area here looked like a downtrend with a lower high, lower low, lower high, lower low, lower high, and then a higher low, and so on. And traders often get confused about this by saying, well, look, this is a downtrend, when it's really just part of a larger uptrend in retracement. And so we need to really build a strategy around the possibility that we see these retracements come in large timeframes if you're there for the long haul. And we looked at a very simple strategy last week around about this 5-period moving average. And this is the Australian dollar. And we put together, this is a 4-hour chart. So every time the market closed over a 5-period moving average, we'd enter it in as a long position. We'd be buying the market. And we have one trade here, 2, 3, 4, 5, 6, and so on. And we correlated out to about 18 trades and got the results out of that. I went on this week and added 19, 20, 21, 22 in there to see how it was developing up. This is what we had last week in our position. I've added in 19, 20, 21, 22 in there. So initially our equity curve looked like this, and with the extra trades in there, our equity curve is developing up into this. The last one was quite a large move. So our equity curve is developing out through here. And also made mention that and let me go back. This equity curve here was developed up on position sizing. It was taken at the stop was taken at the previous low, and simply the number of pips at risk divided into what we were willing to lose, position size, and then we used a 6-bar exit if it was in profit. And win, lose, or draw, we exit on the stop or exit after 6 bars, and this was the result. So I'm not suggesting that that's a strategy that's going to get you that yacht, but it is somewhere to start. So when you build a strategy, you need to put parameters around it, your entry conditions and your exit conditions, so it's repeatable. Not, oh, I would have done this, oh, I would have done that. Simply doesn't work. It confuses your mind and gets you nowhere. So then we looked at the same thing with just a flat $100,000 contract on there, no position sizing. And this was the original equity curve last week. And I made a point that really from trade number 5 out to trade 18, the equity curve had not advanced at all and was at serious risk of a drawdown if you had something go dramatically against you, rather than limiting your losses by position size. And of course, this is the equity curve there. On that one, which looks pretty good, but I again point out that the risk of the volatility risk inside your equity curve is we don't have any reference point, if you like, if that's the right way to put it. So another way of looking at this is simply trending action, and I've got another strategy, if you like, to backtest. We looked at this concept of trend. So we have down here on the left a low, a high here, a higher low here, a higher high here, a lower low here, a lower high here, and a lower low. If we're looking at simply trading, and I'll get my little pen out now, if we're looking at simply trading the moving average, if you like, we could simply draw a line across here and go, look, this one's crossed below that low there. This is my entry level here for the short, and calculate out your stop up the back up here somewhere, and simply enter the trade and take an exit on a bar count or some other technical. Here we have a pivot point at the bottom. That might be a good reason to be out of there, that type of thing. So again, as the market starts to trend, we have a high up here, and this is a 1 hour chart. In the moving average has put in a higher low here, and as we cross the high here, this is our entry level here, and we can put a stop in the background here somewhere. It really doesn't, as I keep repeating, it doesn't matter where your stop is. What matters is if it goes to your stop, you only hand over a fixed amount of your account, not an indiscriminate amount. Oh, I lost $100 on this. Oh, I lost $1,000 on that. That's no way to manage your account. So just work out simply the distance to where you think your stop is, where you might be wrong, or where you're willing to be wrong, and simply position size it from there, and then look for an exit out of there, out of that particular strategy. So simply, I've used a 5-period averager on this. So using our simple trend theory, if you like, our simple trend with a high, higher low, and here we are, we're going to a higher high because it's broken across this high here, and we look for the close above that level becomes our entry. It's worth a quick back of the envelope back test on whatever you're looking at. If you're looking for ideas, just to see if that would work for you. The other concepts that we looked at were these basic patterns. One of them was a cup and handle in silver this week. In fact, right at the moment, we have this essentially this pattern in here. So we've got the higher low coming in silver. It's now working its way up around above this area up through here. So it turns out, oh, sorry, I'll go back here. The other one was the pivot point. The pivot point requires a close above the high of the bar that makes the low. You have a confirmed pivot point. It can operate within 3 bars, 1 bar, 2 bars, 3 bars. And it will accept the 3rd bar as a confirmed pivot point. If we put down some hard and fast rules around what we're looking at on our chart, it does away with a lot of noise in our mind about what is and what isn't what that we're looking for. A pivot point is a very, very simple concept. It can be the basis of a trading plan. It can be the basis of developing up entry rules into whatever it is that you're looking at in the time frame you're looking at. And a reverse pivot, of course, is the spike high and where we see a close below the low of the bar that makes the high. And so we confirm that as a pivot point in every time frame that you choose to look at. And we'll also accept that within 3 bars, 1, 2, and 3. Any bar that finally closes below this level here is within 3 bars. If it's within 3 bars, it's confirmed as a pivot. Now, if you're using a weekly chart, of course, that gives you 3 weeks. A lot can go on in 3 weeks, but if you have a long-term view, then that it's a very simple thing to backtest. This is a point I'm trying to get across here. It is a very simple thing to backtest. It brings context into your observation of your charts. We don't need to have a dozen indicators on there or a dozen lines on there to tell us what's happening. We can work out whether this concept here will give us a stable entry or exit out of a particular trade. The other one was this concept of, and it's around the pivot points, but this concept of spike highs and spike lows. I've got a question here about, can you briefly explain the bar count? Yes, what that, I haven't got the slides for that on this one, but essentially a spike high, this concept of spike high requires that a bar has a lower high either side. And we don't know it is one until, of course, the third bar is finished. But simply a price bar that has a high with a lower high either side becomes the spike high. The spike low becomes the spike low because it has a higher low either side. And these bars can be any color on there. And then we looked at this outside range in there, and I've got some numbers here around that from Ivan Krastens, who was kind enough to send them to me again. This outside range, here's a bar that's made a higher high and a lower low than the previous bar, so that at one stage the buyers are in control, and then in this case the sellers are in control. The market becomes quite confused, and they show up in all different shapes and sizes, but anything with a range that is larger than the previous bar is regarded as an outside bar, an outside period, or an outside bar, or an outside range. This is from Ivan. The numbers on this are staggering. So the hypothesis is that an outside period up occurs within 3 bars of a market top, defined by a spike high. So the defined by a spike high means that the bar itself can be the spike high, but it's basically saying that that becomes the within 3 bars. So we can have another bar to 3 bars, and this outside range here has a statistical value. And the issue is that the outside period with a spike high, including 3 periods, has a 91.86% outcome of marking a turning point in the chart. And the same, the numbers are pretty much the same as a spike low as well. The numbers are staggering. You would buy a dozen Taslotto tickets on this, on these sort of odds on there. So it's there's a little bit of observation. This was a study over 2,622 bars. There was a total of 320 outside periods. They turn out the outside bar percentage, about 12% of your charts are outside bars. And I've done the same numbers on this, and I've found in Australian equities about 15% of your bars are outside bars. So 15 in 100 bars are outside bars. The concept of the I've got a question there about a bar count a moment ago. So when we start to identify these spike highs and we mark them off, we want to then notice the ones that are at least 8 bars high. So this one here, if we do a count back, we've got 1 bar, 2 bars, 3 bars, 4 bars, 5 bars, 6 bars, 7 and 8 bar over there somewhere, but it is an 8 bar high. If we look in this one in the middle here, if we count back 1, 2, 3, 4, 5, 6, 7, it doesn't fit our 8 bar high, so it's not as important to us. And the same, this one here is an 8 bar high, the high of this bar here. 1, 2, 3, 4, 5, 6, 7, 8 in the background. And so this becomes quite relevant. Here, an 8 bar low, the spike low here, 1, 2, 3, 4, 5, 6, 7, 8. Well, no, it's not an 8 bar low, and so on. So we put a parameter around this and said, well, we get lots of spike highs and spike lows in our charts, but the ones that make an 8 bar high or low become a marker for us in the price chart. Getting back to the silver chart, this was taken just last night, a little snapshot of the silver chart, and this is a daily chart. And I pointed out earlier that here we have a little spike low in here. This is the pivot bar. This bar here makes the pivot because it's 1, 2 bars over there. So that's our confirmed pivot point. And we've seen this follow on. There was another one here. This bar here makes a pivot point, of course. And then we saw the final bar here move across this previous spike high and move into this spike high here set back around about the 16th of November. The interesting thing, this is a daily chart, and we often look at this and go, well, this is nice, it's moved its way up there. If we break this down a little bit into a 15-minute chart, we find that as this was advancing on a 15-minute chart, it found resistance at that previous spike high. And then it took 1, 2, 3, 4, 5, 6 bars, 7 bars to get across there. And as it moved a little higher, we found the next spike high, and we found rejection of price at that level as well before it moved on in this case. Now, it's not an exact science, but it is a concept that if you take the time to study your charts, take the time to look at your price action. Why did it do this? What am I looking for here? I'm looking for resistance and support. Where would it be? Well, the spike high and spike low is the first place to start on your charts, and it'll give you a tremendous insight into your price action along the way. So this is what it looks like. These were the spike highs, spike lows. Currently, silver is working its way up through here. I think it still is. Yes, it is. Silver is still working its way up through here. So this area here would be our next concern, around $25.98, to see if there's any rejection or hesitation at that level. And I would stress to you that anything can happen along the way, but these offer us some targets, if you like, or markers that we can work with, and get us a little bit of comfort about understanding our price action in our charts. The other concept that we looked at was this 3-bar reversal, and a 3-bar reversal essentially can be the pivot point as well, but it requires a bar with a high, low, lower high, lower low, 2 bars, and then the third bar remains inside these 2 bars. And here, the inside bar here, that will accept this as a 3-bar reversal, and it remains inside these 2 bars. This range here remains inside the outer 2 bars. The condition we want again with this is it must be an 8-bar low. So this low here must be at least an 8-bar low. So if we count back, 1, 2, 3, 4, 5, 6, 7, 8 bars up here, this needs to be at least 8 bars low. So it gives us, again, context about our price action. As an observation, if you looked at the Australian dollar on a daily chart and marked off all of the 3-bar patterns on here, they all led to higher prices except 2. It was this one and this one. It doesn't need to be more complex than that. There's no indicators on here. There's just simply price action. Now, some of these, I agree with you, some of these are not 8-bar lows. You can sit around and wait for the 8-bar low. That's fine. They're the ones that seem to get a real effort on with the price action, and particularly in here. But that simple pattern where we get high, low, and an inside bar in between those 2 high lows, ends up as a 3-bar reversal. And you can develop up an entry strategy around that, and you can develop up a stop loss around that and simply back test it and see if it works for you to give you context in your charts. So the best momentum trades are, of course, when the other side is wrong. So this concept of buying low and selling high should be the strategy that we're looking for. This concept of breaking out, this concept of breakout trade there's a little bit to go on that yet. I've never seen the turtle traders were very, very successful in breakout trades around Davis box and these consolidation periods, 20 period consolidation periods or 20 period highs and lows. But they had an incredibly high failure rate as well, and they were simply very good at controlling their losses. And when they got onto a runner, they just let it run. So it's always this concept we're looking for as traders is to buy low, sell high. So the again, this concept around pivot points is really what we're looking for in our price action. So I've got a couple of questions here. Do you have a favorite book on candles? The answer is no. The favorite book I have is the one that I'm looking at every day, and I find I'm actually going to show you some of the work I've written around candles at the moment, based on some other work, but they've tried to categorize these candles into, oh, it's a shooting star and it means this and it means that, or it's a doji or whatever and it means this and it means that. Well, yes, it does, but it doesn't mean anything unless it's in context with the rest of the chart. That's the point I'm trying to make. And I'll just go back. This spike low here, type of thing, of this little spinning top candle, means nothing if it's contained within other price action. It's really a waste of our thinking time. We really want to look for the extremes of, let me go back here. We really want to look for the extremes. This is see the outside range here on here. So the thesis was that marks a turning point in the chart. That was and there's another one actually here. That bar there led to a lower bar, and there was another one just here as well. If we break it down into that concept, and here was the outside outside range just here, and here was the outside range just here. So there is, by looking at your individual bars, I know everyone has their screens with like 1 million bars on there and they're trying to draw lines and do all the rest of it. If you stop doing that and have 50 to 60 bars on your screen, even this chart here is too much, but I wanted to get in as many of these as I could. If you look, just put in 50 or 60 bars on your screen and just study what's on there, look for the simple patterns and come into understanding this is the pivot point. This bar here is there's the low down there. It's an outside range, and 2 bars later it puts in a pivot point. Work out what your risk is, there's the trade. Simple as that. That's my kind of take on this. Some observations around the weekly charts. I read a very good book called The Japanese Chart of Charts, and inside there was a thing called the Haguro method, and I've talked about this for many years. I just want to bring a couple of things to your attention around this. Basically it looks on a weekly price range. So the high of the week and the low of the week, it looks at where the middle of the bar is as being a significant area, the middle of the range of a week. Not, and this is only applicable on a weekly chart, but the middle of the range for the week. And then we want to notice when the bar finishes on Friday, whether the open close is below the middle of the range or the open close is above the middle of the range, what color it is, or whether the open and close covers the range like that sort of thing. That's the things we want to notice about how it moves around this middle of the range. And so they're categorized into basically eight. These are the only 8 green candles you can have on a weekly chart. Number 1 here has the body below the midpoint there, and then the number 2 has the body that covers the midpoint, so the middle of the week, the range of the week is here, and so on. And so we categorize them that way, and the red ones are simply the opposite patterns. But there is a very well-founded observations around what's happened during that week. And we look at these types of candles and go, well, okay, well, candle number 1, and this has the body, the open close below the middle of the range of the week. So the market is opened here. At some stage, it's traded all the way up here, and then it's been rejected and closed below the middle of the range of the week. And so it basically says that the following price lines, even if a rise in price takes place, will be limited and a lower price will be set. Now that's a fairly big statement. So I just want to go to a couple of charts here. And as I said, it's done on a weekly chart. It's done on a weekly chart, and we find here, and this is what have I got here. I've got gold here. I'll just drag this. Sorry, just drag this across over here. So here is our. Oh yeah, good on you. Here is our number one candle. So the body is below the middle of the range of the week. And here on gold, this is the body, the open close is very close together. This is a weekly chart. The open close is very close together. And it basically says, as I said earlier, it says, even if a rise in price takes place, will be limited and a lower price will be set. Small fluctuations will occur in the price and tend to move to the center. So that's following this week. And we certainly, oops, what have I done? We certainly saw that, and it was then it set an outside bar the following week. So it basically said that the number one bar says, you know, this is over. We're not going anywhere. And certainly the following week did that. So we can take each bar, in context. I'll just come down to this one here. This number 15 bar. We'll just go through what that is. So 15, where am I? 15 indicates erratic price movements in the following weeks, as this line makes an appearance when the price is declining, can indicate a low price area. Let me get that off there. So number 15 can indicate a low price area, and it basically says erratic pricing and price movements in the following weeks. And we saw the market move higher, then the market move lower, and so on. And eventually we saw no, it's not an outside bar, but we saw an inside bar and this consolidation, then a breakdown following that. So what we're concerned about in a weekly chart is the actual middle of the range. And if we look at these, even in this gold chart here, if we take this white bar here, I can't draw on this because this is actually MT4. I can if I do this. This area here, the middle of that range, we find often can act as support in the following weeks, and we can find that the middle of the range can act as resistance in a weekly bar. And so we find then that when the middle of the large range bars, we're just simply eyeing off the large range bars in here because the previous bars are shorter range bars, if that middle point is broken, we often see follow through. Here, the middle point was broken here and we saw follow through. Here it was broken and we saw follow through, and so on. So it's a concept around the strength of bars on there, and again, it's here, the middle of this range, and once that is broken, we can find other evidence to enter a trade, but it'll give us context around our price, and so we can simply mark off when this one was broken. We can mark off here's one that was broken to the upside right there, and that one didn't work, so you'd be taking a stop, and so on. So it offers a context around support and resistance on a weekly basis. It is a very, very good method, and it is worth your while investigating that type of price action. So I'll just take some questions now on this. What do I think of SFR? I don't know. Let's have a look. I'll bring Iris in here. Have I got it on here? SFI, yeah. Okay, so let's take a look. If we take a look at this, the first thing we do is we go to a weekly chart. And we notice on SFR on here that there's been a high up here, a low, lower high, lower low, lower high, lower low, lower high, lower low. I often used to say in workshops, it is my desire that you'll wake up in the middle of the night going lower high, lower low, higher low, higher high type of thing, and a lower high and a lower low. So then SFR rallied, put in a lower high again, and then put in a higher low. And a couple of weeks ago, it moved past this high, so we've entered into an uptrend. If we take our little concept around midpoint support, we'd be looking at that bar there, the middle of this range, this large bar here, we'd be looking at that as providing some form of support. We can see that the price was rejected here at a significant outside bar as well, but at a spike high. This was the 8-bar high here, and price was rejected out of that. A lot of traders complain about stops being hit, and then the market goes in the direction that they thought it was ever going to go. It's essentially the fake out, where the market simply fakes out a previous spike high or spike low, and we find price rejection there. It's not an exact science, but it occurs enough to be statistically significant. So we've got our support level here. So our support level will be registered around about $5.15. We have a very large range bar here and 2 short range bars here on the weekly chart. We come down to the daily chart on this. This is where the weekly, this is what I like about Iris, it leaves a line there. So we have, you can see here, the outside bar here marked the high of the current price, about 8, 1, 2, 3, 4, 5, 6, 7, 8. One of the bar counts that I mentioned, in an earlier webinar is simply looking at this, and there's a spike high in here, even though the 2 bars are equal, we'll define that as a spike high. If that high is not broken within 6 bars, 1, 2, 3, 4, 5, 6, price is going to struggle. And the same, if you look through your spike highs and spike lows, you'll often find that the significant ones here, there's a low, 1, 2, 3, 4, 5, 6, and the low wasn't broken. Saw more consolidation. The next significant spike low was here, 1, 2, 3, 4, 5, 6, and then we saw the breakout, a breakout rally. So we now have the daily chart declining. This is our support area, $5.15 on here. We'd be looking for either a break of this level or a break or a pivot point of some sort to come in on this thing. So now we look at this in the afternoon and go, okay, has it met this condition? Has it met this condition? And then suddenly your trading has context. If we say that if a pivot point comes in on here in the next day or so, we simply mark off where our stop's going to be, we calculate our position size, and that's the trade. That's the trade. So SFR, another one here, but a bit tricky about the EU. Is it affected by numerous daylight savings? Yes, it is. And the US as well. That's your business, is to work out where those are. Let me get to the questions here. To the middle of the range. No, yep, got all that. Weekly higher marginal now in a retracement. Yeah, so it is. Sorry, I'm looking at the same. I've had a couple of things on the SFR there. So if there's any other questions, would be good to. Otherwise, I'll just go off on a bit of a tangent here and look at some of the and go over this again. We'll look at a couple of equities here. The banks at the moment, if we pull up the banks on a weekly chart, ANZ for example, we talked about this in week 1 and week 2 about trend lines in there. And if you draw your trend lines correctly and they go from the high to the high, never cut through price action when you draw a trend line on your charts. Trend lines are not drawn as a best fit like that, like that type of thing. That's not a trend line where you're disregarding buyers and sellers outside of there. It's simply wrong. It will confuse you over time because it means that there's no fixed rule around this, and you'll simply draw what you want to see on your chart. Trend lines start from the lowest low, and then they go to the next significant low until they're broken. So in case this one may have been there, but this is the real spot here because the market's made a low, market's made a high, market's made a higher low, and it's moved out past the high. So the trend line is drawn from this low to this low and then extended forward. And we see the same here on the highs, that if we were to extend, let me get this down here. If we were to extend these lines backwards, they do not cut back through any price action along the way. So this line here is valid because if we extend that backward up here, it doesn't cut through any price action. Drawing lines inside your price chart like this, from that point to that point, if you extend that backwards, it does cut through price action. This is not a trend line, that's simply a bit of chart art on there. So now we can define ANZ as in a weekly chart as the low, the higher low, and it has broken to a higher high. And we have one downtrend line that it is simply dealing with at the moment. If we break this into a daily chart, if we go, okay, where's my entry on this? Let me open this up a bit. Where's my entry on this? We can see that the market is in a secondary consolidation. So in a secondary consolidation, we said that our support and resistance levels are the last high and the next low create our support and resistance levels. No matter what happens after that, the market, this was our resistance level, this was our support level. We've got this rally in here. So now we have ANZ inside this secondary consolidation in here. It's done it before. Just let me draw, bear with me, just let me draw this one on here. This becomes our resistance level. Sorry, wrong one. That becomes our resistance level. And then our next low following that was here, becomes our support level. So you look for the first low after the high, becomes your support level no matter what happens after that. It will give you a tremendous amount of context, even if it is from the second or third lower high. Not sure what that means, as long as it doesn't come back through price action. The trend line is valid. Yes, that's right. Even if it's from second or third lower high. So what I'm stating is that as the, let me find something that I think what you mean. Oh, sorry, I've got so many lines on here now. This area is the high. This area is the high. This is the one that, this is where your first resistance was. It's also an 8-bar high here. And this was the retracement. So this line here becomes your support level. And so it's noticeable that when the support level is broken, and in this case we had a bit of a descending, sorry about the phone, a bit of a descending pattern in there, and then the level was broken, and then we rallied out of there. This is what happens in secondary markets along the way. Let me go back to the weekly chart on this. This retracement down here in the weekly chart, this secondary consolidation, and we identify it as a secondary consolidation because the bars are overlapping each other, and then we have the primary move underway, and currently on a weekly chart, ANZ is in a secondary reaction. I'll come back to the daily chart here. So the daily chart is also really shows up that weekly secondary reaction. So these can develop, we can see down here, they can develop up over months. This is really what we're looking for down here at this support level. Is there an opportunity to buy down here, either via a pivot point, an outside bar, that type of thing? Or are we looking for a close below there in continuation lower? That's the best we can do as far as our analysis goes. We're not here to predict so much the future. That's not what technical analysis does. Technical analysis does do is gives us context, or gives us strategies around price action that we can identify. Like, for example, the pivot point down here, the 3-bar reversal down here, the 3-bar reversal here. That type of thing is what we're looking for in our price action. Sorry, a question here, APX. APX. Oh yeah, good on you. Oh, there it is, yeah, got it. Okay, so if we go to our weekly chart, first thing we do is go to a weekly chart. If anybody asks me a question about a stock or anything, I always go to a weekly chart. When they, for some reason, when I'm on TV or whatever it is that they do, and they ask a question, I'm always looking at a weekly chart. So it's quite clear to see that the market had a strong rally out through here, put an outside range in here that marked the high. Market retraced, put in a lower high. There's a pivot point between that bar and that bar that sets up the pivot point, and now we have broken the low. So technically the stock's in a downtrend. No issues with that. So we've gone through on the weekly chart. If we again pull out our midpoint support, we've gone through our midpoint support. We found midpoint resistance up through there. That was a large bar. We found midpoint resistance up through there. If you're long on this stock, sometimes you've just got to go, no, I'm on the wrong side of this. So we've got the stock coming down here. And I think this kind of defines really what I've tried to get across over the last 5 weeks is that people will read reports and listen to stories about what a stock should be doing, what it might, what's coming up for them. But it's only the price action that will make a living for you, not what other people say about it. And it's really the price action we need to study and focus on for our trading. So we bring context into our chart, and we have in this weekly chart. Last week was a long range bar. This week is a shorter range bar so far. Maybe it's good, but it's certainly in a primary downtrend. So let's go to a daily chart. So our daily chart, we have the gap in here. Again, you see the gap away there. So this this becomes our first support area on the daily chart. The high up there was resistance. This becomes our first support, and then our next resistance level comes into here. And so we've set up our support resistance levels. And currently here, you might have a chance of, we'll see how tomorrow goes, but tomorrow's the 3rd day. So if you're looking for a pivot in there, if this gives a buy pivot, which is a close above the bar that makes the low, let me just go in on this. This is the bar that made the low. This was yesterday, this was today. If another day comes in and we get a high, a close above this high, if we get a close above there, we'll have a pivot reversal in there. And let me say it very clearly, it is a pivot reversal. It is to take a position again on that. You are trading against the trend. The trend on this stock is down. To be a buyer down here, which I don't have a problem with, but we need to acknowledge I'm buying against the trend. When we find stocks that trend upwards and we look for a buy inside a confirmed trend, probability is stacked on our side dramatically, and I mean dramatically. So we've got, because the recovery in price down here could simply be short covering at the end of the week, gives a false buy signal, anything like that, and I'm just advocating trade with the trend. Things will work out a lot better for you. Another question. XJO, yeah. I've not been all call. Do you have any fundamental analysis? No fundamental analysis. I don't read any fundamental analysis. I spent 7 years broking on the broking desk for the likes of Macquarie and RBS, and I never read their stuff except a cursory glance. But no, it was all price action. it was all price action based, because it's stuff that they make up in research is terrible. Here we go. So weekly chart of the index. Let me just open this out a bit. When you analyze your prices, as I mentioned earlier, just stand back behind your chair and have a look where it's going. This is a weekly chart of the index, a series of higher highs and higher lows there. Then we had a corrective move down through here. So a corrective move takes out the previous low in one fell swoop. Doesn't change trends, it's just simply irritating. And they happen from time to time. Then the low, the higher low, and the higher high. Then a corrective move again, as everyone knows, earlier this year. And we've now started to trend again. So we had the low. In the weekly chart, we had the low here becomes our support level. The next, there was two. There was actually one here as well. And the next spike low was there, not so important. But the real one was this bar up here became our resistance level. And as you know, we entered into basically a 12-week, 13-week consolidation in there. Then suddenly we broke out, but this was the first resistance level on here. We put in a little higher low just here, 2 parallel bars, pivot point at the bottom, and 2 parallel bars here, and then now we're broken out. So we've re-entered back into this primary uptrend on here. That if we're looking at midpoint resistance on candles, this is our midpoint resistance here. I'll often mark these off on the charts in the black and white report on the FP site. And if we're looking for midpoint support based on our candles, we're looking at this level. Sorry, the last large range bar was there, and also there. So if we saw any retracement, we'd be looking for this to meet these support levels. Interesting thing in the index right here, and we're still in this weekly chart at the moment. In the classification of our candles, we have a line 15 came in last week. Line 15 indicates erratic movements in the following weeks. As the line makes an appearance when the price is declining, can indicate a low price area. We saw one of those down here in a low price area, this type of bar. When found in a high price area, close long positions when the following week trades and closes below the low. So we're looking at this bar here, the low of this bar, providing an exit out of long positions. If it closes below this low, which is 6628 thereabouts, 663 or something, that low there would be an exit out of any long positions because it shows that the market is simply again rejecting higher prices. This bar here, this number 3 bar here, is also an issue. If it's found in a high price area, long position should be closed within a week, but it basically gives 2 or 3 weeks warning that we may see a fall in the market. So it's easily provable when you go back in your price action. And there was one here, and then 1 week, 2 weeks later, and we saw the rejection in prices. There was one just here, 1 week, 2 weeks, and we saw the price rejection out of there. And it shows up with statistical regularity, if you like, that it needs to be taken notice of. There was a couple in here. They took a couple of weeks to play out. We had, I think there was an outside bar just here. Certainly was just here, outside bar, and then we saw the market top marked right there. So when you look inside your question there about bearish divergence, good question. Let's put an indicator on here and have a look. When you study your individual bars on your price action, you'll notice that this will open up for you. And let's put a relative strength on here. So relative strength, there's no, excuse me, there's no divergence here in the weekly RSI. We can see that the RSI here is trading below, is still below the 70 level, and it's above the 50 level. This is basically nirvana as far as the RSI goes. This is a fabulous place to be on there. So we'll take a look at the daily chart on here. So the daily chart, yes, the daily chart shows divergence, and we'll take a look at that. We discussed indicators in the third week, and divergence, what divergence looks like, because the relative strength is calculated on the closing price of the bars, we don't use the shadows or the wicks of the bars as our reference point. We use the closing price of our bars as a reference point. I'll just open this up a bit. I'll bring this right down here. So what that means is that we look at this high just here, which is this bar here, and the next one just here. So we can see that the market's made a new high, but the indicator, the relative strength, has not made a new high. I went through the calculations of how that's worked out in week 3. It's on the video. We saw the relative strength come over 70. And I would point out, a lot of people say that relative strength over 70 is overbought. No, it's not. It can remain over 70 for basically weeks if it wants to. In this case, it remained over there for a week and a half. But it made a high here, it made a low here, moved over 70 again, has now come back below 70. And the key area here is it needs to move below this internal low right there. And it really didn't do that. So this low here becomes the swing sell point. If we saw this relative strength move below there and we saw the price action confirming, that would be a swing sell. That signal has failed and the market has simply gone on to a new high here. There was a pivot point here 2 days ago, and today we've closed out basically on our highs in there. So we're trading in the line of the weekly trend, and a lot of people go, oh, the market's too high, the market's too low. I'm telling you, the market can do anything it likes. The weekly primary trend is up, so we're looking for buy opportunities in line with the weekly trend, the primary trend of the market. We come into different time frames and we look for buy signals inside those time frames, whatever suits us. What we're looking for, whether a day trader or intraday trader. An intraday trader would be looking for long signals inside a primary weekly uptrend, that type of thing. Bearish divergence. Is there anything else that I need to go through here? I've gone a bit over time at the moment. No, it's all good. If there's no other questions, I'll go back to my slide presentation. I'll make some arrangements with Evan that I can make these notes available to you, if you like, particularly this around this candle classification. Yeah, can't understand the notion of pessimism when we're in a multi-year bull run. Exactly. Exactly. Great statement. The question was a counter trade. Yes, if you understand that, that's fine. Yep, and I'll organise the notes for you. So this concept, the notes are fairly simple. I'll arrange with Evan that we can get the notes to you if you'd like them. But I'll leave this here, slideshow. Okay, so these lines, this line number 3 here signals reversal. Line number 15 here signals consolidation. Following that, and there's lots of examples in the notes. I won't go through them here at the moment, but there's lots of examples in the notes about what they look like. And what I want to get to is down the bottom down here to here. And if you have any comments or feedback on these webinar series, you're welcome to contact FP support. And other than that, I would wish you a very great Christmas this year. We've been through enough this year, so it's time to at least sit back and enjoy the family and friends. So thank you very much on behalf of myself. I'd like to thank FP Markets for allowing me to put this on, and I wish you all the best for 2021. Thank you.